Well, when it comes to the political scene over in Nigeria, very interesting, because with less than 6 months to the polling day in Nigeria, we've got President Jonathan still not saying whether he plans to stand. Just what kind of market sentiment is about around that kind of news that's out there?
Well, the fun thing about it is that traditionally, what you find is that the political scenario seems to affect more of the offshore investor in Nigeria than the onshore investors. It's almost a situation where the onshore investors have sort of factored that in most of their decisions, are sort of used to the wranglings that happen at this time, and doesn't have significant effect. As we speak now, the uncertainty as to whether he's going to compete is still not a factor yet in the markets.
Well, Leon, from a foreign investor perspective, I mean, what kind of sentiment does this trigger amongst foreign investors, where there's this uncertainty of how the political landscape is going to play out moving forward?
Well, generally from a foreign point of view, you like to see some form of continuity, because then at least you know what's happening. You sort of can build up some form of expectation of where things are going. So, you know, should President Goodluck Jonathan, you know, stand indeed, as it increasingly looks like he will, I think it would go down pretty well with foreign investors. But, you know, at this stage, though, one probably needs to say about how, you know, what role do foreign investors play in the local market, in the local rates market, and it'll be very little, right? Because interest rates are so low in Nigeria at this stage, you know, that there's not a different story in the equity side, but on the interest rate side, foreign participation is very, very limited. So.
So, Sola, run us through the kind of activity you're seeing on, you know, the fixed income side of things when it comes to foreign investor participation and then local investor participation.
Okay, like I was said a few seconds ago, in this year, we've not seen significant foreign investment or foreign investor participation in the fixed income market. And clearly, like was said, because the yields are pretty low in comparison to the other alternatives that these investors have in other countries in Africa, or even in their home countries by the time you factor in the country risk factor. But on the onshore side, this year has been pretty active. We've seen yields drop significantly at the beginning of the year, and we're beginning to see a rebound now. I think people have started to realize that some of the yields we saw a few months ago are really unrealistic by the time you take into consideration the cost of doing business here, inflation, and it will be a bit strange for someone to be willing to invest in a 20-year government asset at about 7–8%. On the back of this, we're seeing less demand for these instruments and begin to see the yields go up. As we speak now, the new 20-year issued is trading around 10.6. And the old 20-year bonds are trading about 9.3, 9.5. This is a bit different from what we saw a few months ago when they were trading sub 8%. And it's the same story across the yield curve. On the 3-year, 5-year, 10-year, we're beginning to see the rates begin to pick up. In fact, there's an expectation that in the next auction, which should be in about a week or two, we might even see the 20-year cross the 11% mark, and this will take us back to the sort of levels we were a few years ago.
What kind of dynamic are you seeing evolve, though, if we're bearing in mind the fact that we've got the equity side of things picking up steam now that the banking sector is seeing some resolve filter through, and that creating much impetus in terms of investor appetite for equities? Are we seeing a shifting away towards equities and away from the bond market, or are we looking at a stronger case right now having been built for investors to diversify their investment portfolio?
I think that is the key point. As funny as it may sound, the crisis we saw on the equity markets was sort of a good thing for the fixed income markets, because before that, there was very little interest in the fixed income market. And when we had the crisis with the stocks prices dropping to significant lows, investors had to seek other opportunities, which sort of brought some awareness of the fixed income markets to these investors. Now, in the short run, yes, when the equity market starts to pick up, we would see some funds leave the fixed income market to the equity market. But overall, in the long run, I think we would still see that the fixed income market will be relatively more active and deeper than it was when the equity market was very, very buoyant a few years ago.
On the back of that, Leon, I mean, do you see interest picking up in terms of corporates using this avenue to raise capital moving forward, the alternative to raise capital, where we know that the banks in Nigeria, despite seeing this turnaround, are still pretty tight when it comes to lending?
Yes, I wouldn't be surprised if that happened, you know, because Sola's sort of hit a number of issues, you know, nail on the head. And one of those factors that he didn't mention was, of course, the growth in assets under management in the local pension fund industry. You know, it's been quite a success story, and the expansion of the assets under management. And this money needs to find a home. You know, so I think there's huge opportunity for corporates to go out and to issue because of exactly what's happening on the demand side in the local market.